So how would you like to get rich quick? Just do a little bit of trading, start with a small bank, create an enormous bank and walk away to sit on some beach somewhere. Now that sounds appealing, doesn't it? Which is why that is what you're always seeing shoved in your face. Make a second income from this, risk-free that, and so on. But in fact, real trading is actually a lot less exciting. And in fact, I think that it can be fairly mundane at times. However, it can be really, really effective if you're willing to put the effort in to trade properly. So what I've done is I created an account with a small amount of money, multiplied it to a larger amount, and I'm going to show you how I did that in this video. If you're interested in trading with BetAngel, then visit our website where you can download a free trial of BetAngel Professional and BetAngel Trader. If you want to learn how to use them, then visit the Academy where we give you a detailed, structured walkthrough of each product. And if you're an existing user, then head on over to the forum where we have a load of files for you to download to customize and use within BetAngel. So I recently funded an account with £300, and what I'm about to show you is what happened from that particular point onwards. And like I've said, this is to demonstrate exactly what real trading looks like and what I believe your approach to trading should be. Now, it's important to remember that I've been trading for a long period of time, so it's almost second nature to me. I feel very comfortable with taking risk in the market with what I'm doing. I recognize scenarios and strategies and when I should deploy them quite easily. For you, it's going to be different because everybody is slightly different. You have a different risk tolerance to me, and therefore I'm not pitching this as in you can achieve these results, even though you could, because it's very likely that you will end up with different results and you'll be at a different stage of your career. So I just want to insert that caveat immediately into this video, just to say to you, be aware of that. You're not going to suddenly start trading incredibly effectively tomorrow if you've only just started out. You're going to have to learn about yourself, you're going to have to learn about the market, you're going to have to learn about strategies and being able to execute those well within the market. But yeah, I funded this account and the idea was to try and trade it effectively to see where I ended up inside a month. So let's understand exactly what I did and what the results were. So the market that I chose to trade here was pre-off horse racing. Now, of course, there are many different trading strategies in many different markets that you can use, but I'm going to explain briefly why I chose this particular market. But the main reason was because it's what I define as a pure trading market. If we put a position into the market 5-10 minutes out, half an hour out, and then we trade out of that position when we actually get to post time, then what you will find if you do that at random is you get random results. Half of the trades will win, half of them will lose, and it will sort of balance itself out over a period of time. So if you trade it randomly, you get random results. But essentially, when you trade pre-off horse racing, your base rate is more or less 50%. If you trade completely at randomly with no skill whatsoever and not putting any particular knowledge or strategy into the market, you'll just end up breaking even. And that is because the returns are equally distributed. I've just said that 50% of the time you'll be up, 50% of the time you'll be down. I've generalized that, but generally speaking, your chance of a profit and a loss is reasonably equally distributed. But also on pre-off horse racing, it's a market that's driven by emotion and opinion. It's got no relationship to what's going on the actual race itself, and if you trade in play, that is always going to be the case. So that base rate, that strike rate, is going to be reliant upon what you're doing and the market in which you're doing it. But the reason for choosing pre-off horse racing is simply because there are loads of markets. It's a pure trading market. There's no reliance upon what's going on in the underlying sport itself, and therefore it makes for a good example as to exactly what you should be doing when you're attempting to trade. So I started with a bank of £300, and then I would use that bank to be able to trade in and out of the market and try and multiply it to larger amounts. So how did I do? Well, if we bring up the equity curve, then what you can actually see here, on the left hand side we started at zero, and on the right hand side you can see that that's grown to about £1,000. So using £300 I managed to get a profit of £1,000 on a series of trades. We'll talk about the detail of this in a second. But if we look at that graph, you can see that I got off to a very good start. It accelerated up fairly quickly. If you're using small stakes, then one of the advantages that you've got is you can get in and out of the market quickly. That's a key risk factor, because the quicker you can complete that trade, the less risk that you're taking. If we open a position, close a position a few seconds later, the market has no chance to move against our position. So that's pretty advantageous, and that's what's behind that sudden acceleration that you see at the start of this particular trading journey. Now, as we go from there, it begins to flatten out a bit, but you can see there's a generally upward curve. But you can also see that there's like a spike in the middle. What is this? Well, the great thing about trading is if you're trading correctly, you're very often a little bit defensive. You're trying not to lose money. That's one of your key objectives. And every now and again, a really good trade will come along. So when you see that good trade, you can jump on it and make a reasonable amount of money from it. And when you see those little spikes that occur on this particular graph, that's what's happening. We're actually seeing some really good trades appear, and I'm jumping on the back of those. But what you're actually looking at to get that £1,000, as I was probably trading, I haven't got the exact number immediately to mind. I'd have to look at the spreadsheet, and I'm not going to do that now. But it would have been somewhere in the region of about 500 or so markets. So the average amount that I made per market was only about £2. But remember that that £2 is going to be made up with a +5, a -3, a +20, a -10. It's a mishmash, a mixture of all of those things, because what I'm trying to do here is to get a positive expectancy. And I have done a great video on expectancy. It's a lot longer than this video will be, so I suggest if you want to learn about how to create a positive expectancy, go over and watch that video. But essentially what I'm trying to do is to not win every time. I'm going into every market assuming that it could be a profit, it could be a loss. And it's important to remember that trading isn't about eliminating risk, it's about taking risk. People seem to forget this. People are obsessed with winning but not with profiting. They want to have a winning trade, but they find out at the end of a month or whatever that they actually haven't made any money. And that is because trading is about taking risk. That's fundamentally what it's about. You put some money in the market, you take some money out of the market, and hopefully you've gone away with a little profit. But it's not inconceivable that you will potentially make a loss. So it's important to get the expectancy right. Your expectancy will be the amount of times that you win, the amount of times that you lose, how much you win when you win, and how much you lose when you lose. And you need to be measuring those 4 things in the market to be able to trade effectively. If you're not profitable, one of those 4 things is going to be out of kilter, and if you know what that is, you can start to address it. So the game that I was playing here was basically to just get a positive expectancy. I was trying to minimize the amount of losses that I had when losses occurred. I was trying to get a reasonable strike rate and let profits run when they occurred as well. I wasn't doing anything particularly special. There was no secret here. I wasn't using some amazing strategy that I haven't explained before. It was a mishmash of many different strategies that I've used and demonstrated to you over a period of time. And your role as a trader, should you choose to accept it, is to approach a market, think, I wonder what could work here, and then deploy that strategy to the best of your ability into that market. But you also have to recognize that you may not win. If we look at all of the races that I traded in this particular sample, I won on about 70% of them, just slightly short of 70%. So basically 3 out of 10 markets I got completely wrong. And what happened when I got a trade wrong? I didn't perform any magic, I didn't do anything weird or wonderful. I basically tried to make the trade work, realized that it hadn't worked, and then I exited my position. I did not modify my behavior, I did not chase losses, I did not do something amazing. I basically went into the trade, it didn't make money, so I closed my position and moved on. And I could do that with confidence because I knew that my long-term expectancy was probably going to be positive. That is typically the way that you trade. It's not about eliminating risk, it's about taking risk. You've got to accept losses, you've got to realize that they're going to happen, and you have to be comfortable with it. And the way to be comfortable with it is to not look at the next trade or today. You need to look at what you're going to achieve over the course of the week or over the course of a month. And on this particular occasion, I started the month with a bank of £300, and by the end of this 4-week period, I'd managed to turn that into £1,300. So I just did that by doing roughly sensible things at roughly sensible times, looking at the markets, thinking about what strategy could work in those markets, and then executing the best that I could against those markets. When losses occurred, I basically just took them on the chin and moved on. They meant nothing to me. It was just part of that trading process. Anyhow, I hope that video has been useful for you.